It's another day and another record for Wall Street. We're seeing record highs for all the major equity averages. So joining me without further ado is Keith Bliss of Cuttone & Company. Keith, good afternoon. Thanks for joining me.
Hi, Remy. Good to be with you again.
Well, first and foremost, we're seeing record high for the equity averages. We had mostly better than economic data releases with retail sales and that CPI figure coming in above expectations. But we did get some weak data. But the point is that Trump has been promising massive tax plans, as well as Janet Yellen speaking today. So given that trifecta of data, Trump, and Yellen, can we expect extended gains?
Well, my initial thought is that, Groundhog Day is really on February 2nd, but it seems like every day down here is Groundhog Day as we go along, as we set new record highs. And I don't see any reason why it will not continue. When you talk about the macro, the convolution or the convergence rather of the macro data, the earnings that we've gotten for the fourth quarter, where the markets are positioned technically, the noise is coming out of Washington, that's an all recipe when you put it into the mixing bowl that really spells success for risk markets and equities in particular. So the way I view the market, and I look at all those things pulled together, I can't really see anything on the horizon that we know about today that would really derail this rally going forward. I don't think it'll be a strong, 0.75%, 1% rally every day. We will get some bumps depending upon what comes out of the Oval Office, but it will continue to be a slow grind higher. We're in uncharted territory with each passing day. Certainly from a technical standpoint, that's true, and there's really no overhead resistance that we can calculate at this point in time. So yeah, I would still be long equities here.
And now that we've covered equities in the U.S., I do want to shift our focus on over to the Eurozone. Now we have national elections coming up in many countries, and of course we've been hearing more about Greece. So given what we're seeing in the currency markets as well as statements coming out from these central banks, where are the risks right now?
As you're correctly pointing out, as we look outside of the U.S. borders, I don't see a lot of risk inside of U.S. indigenous to the U.S. market right now, but we could be impacted by some things that are happening over in Europe. As you're correctly pointing out, we've got some key elections coming up, most notably in France. And I read something that was interesting today. Who will be the wiser person is with this populist movement that has swept the globe over the last year? The wiser person being the one that's saying, "Oh no, we're in for a lot of trouble," or "Oh yeah, this is an opportunity because the world order is changing." I'm tending to look at the second response there with what we're seeing there, the disruptive nature that the Trump election, Brexit, perhaps Marine Le Pen being elected president over in France, even though that's a long shot, but just the basic trend to disrupting the status quo that we've been living in from the post-World War II era, I think will be a benefit to the market longer term.
Okay, Keith, last but not least, before I let you go, I want to ask you about oil. Now, we got the API figures as well as record levels for the EIA crude supplies from the latest week. So given that on one hand, we have the production cuts from OPEC finally coming into play for rising U.S. inventories, are we going to continue to see range-bound trading for oil prices?
For the foreseeable future, which for me is certainly the rest of 2017 and beyond. And some of the models that I look at, which again tell me overbought and oversold situations, you can tell when volatility is being sucked out of a particular asset class because the oversold and the overbought values get narrower and narrower. We've seen that in oil right now. So if I were to look at WTI crude, for example, we would call that oversold at around the $50 level and overbought around the $58 level in today's work. And that just tells me that there's nothing in this market when you see the supply side of the dynamic and then the demand side, even if we assume that China has threaded the needle and their demand will start to pick up for the commodity, I just don't see it breaking above $60 anytime soon. It's not an asset that I would really be playing right now, either on the strict commodity or the equity-related ETFs, because I just don't think you're going to get a lot of movement in it.
Okay, Keith, well, thank you so much for joining me today, and thanks for your insight as always.
My pleasure.